This is the second part of a two-part episode. If you haven't seen the first part, you can find it on Quantpedia YouTube channel, where the discussion begins and provides the full context.
Historical calibration of model parameters via machine learning goes by looking back in history. Here's an example. This is a calibration of the value for gold based in 2025, and I think this is September 1. What we do here is we go back in time, and that's variable. This is one of the parameters that are incorporated into this. If you look at the parameters, they look at, for example, best of breed horizons. Do you want to rebalance every 1 week, every 2 weeks, every 3 weeks? How much, what interval of time do you want to rebalance? How far do you look back? Do I look back 6, 8 months? Or shorter time? I mean, ideally, when you think about this, what you would like to do is to capture a historical region where things are relatively stable. In other words, that things maybe are getting a little messy, but that's the ideal, since it's difficult to measure that. We haven't incorporated that aspect yet. What we do is we look at different intervals of going back. That's one of the parameters.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports, and save hours of work. Quantpedia Pro, your edge in quantitative investing.
Another is the short rate period, how things are progressing in the short, other patterns, etc., that result in optimal performance. So we look back like 7 months here, a little bit more, and we look at a bunch of different parameters, maybe 50 to 100 combinations, and run through each one. In other words, we calibrate our model parameters by going through looking at dozens and dozens of possibilities and running the model forward to see how it behaves. And how it behaves here is the following. How it behaves, the normal price line graph is given down here, the orange. The red is the actual price. This is the potential jump size at this point if kappa were 1. And this is the time interval here. And then this is the echo price long and short. Okay, so turns out that this particular set of 50 to 100 parameters we look at would give a historical return that looks like this. And now we postulate, okay, it's doing pretty well. We postulate, okay, that's going to happen in the next interval of time, which is one of the intervals that was selected via one of the best of breed horizon parameters. In this case, 1, 2, 3 week periods. So this is what we got. Okay, it looks pretty good. It outperforms pretty well. That is the parameters that we take at this point, which we assume is today, to calibrate our model going into the next period of time. And that will give us the hedge score to apply to the model going into the next period. You can see that it's not going to work all the time in every period, but what you would like to get is the number of times that this work is a large percentage. Certainly above 50%. And if it gets up to 60, 70, 80, that's even better, of course. That's fundamentally how it works. And so there are different ways to measure now the parameter settings that you get to generate a model that looks like this. We're always looking for outperformance. If we can't find outperformance after going through all this, then we give up, okay? This one doesn't. Just might as well stay at doing nothing. We can't give you a good answer. But giving a good answer is something that we can get out of the parameters that come out of this model. There's too many to go over. We won't go over this. Some future time where we go through maybe more in the analysis and applications in real situations. So this is a parameter estimation results on a weekly rebalancing. And we go through 4 examples. And these are all run at the same time. This is a calibration result for the U.S. growth stock. And notice here, okay, he's not doing so well all the time. Picks up in the end. Okay, well, we hope going forward that this is what it's going to be. The return that we get from the index is at 1.55%. The levered value is 19.31% going into the next period. This one comes out, U.S. technology sector, comes out similarly. Coin return, okay, not so much. It's a little messy. We have difficult to estimate the Bitcoin, and we did okay here, but not so good. I would be cautious about using it yet until we develop a little bit more information coming out of Bitcoin. Tesla returned. So the drop here was much bigger because it was planning on continuing to be levered. It didn't, so it dropped bigger than actually Tesla did at this period in time. Tesla returned 515, levered 407. Okay, so it didn't beat it. And just to mention, when we went through there's all like 10 at each period in time, gold levered lost about 1.65%, but the 5 average raw underlying equal weight total returns of 1.72% compared to the leverage returns of 8.70. But that's primarily because of the growth stocks and the technology stocks did so well. Created 7-Eleven and valuated 1 week on. On the whole, they did so well. Some stocks did so bad. This is a historical example, which was in the original paper. The abstract is shown here. And this is the outcome, which actually came out. This is the S&P 500, 2007. There's a lot of stuff here from the original paper because we looked at a couple different components than just the Echo, which is the optimal efficient portfolio. The black one, which did pretty well. This is the normal price, the pink one, and this is the Echo signal. And these are the results. Optimal efficient portfolio, Echo portfolio gave a 20% CAGR, cumulative asset growth rate, compared to the actual, which was a negative, the blue line, negative. And the other indicators, Sharpe ratio, max drawdown, CalMark. Did pretty well in this example. And I have to say it was kind of a creeping, it was pretty fast. Because of some of the initial drawdowns, it was able to get a handle on things quite early. 2007, it was a big crash, but it didn't happen so quickly. 3 applications that actually were run, I want to mention. AugerMax is using as part of its global tactical asset allocation. Rob is going to talk a little bit about the results on that. What we're doing here is combining fundamentally 3 things. The Echo process for short-term rates, a stochastic optimizer and risk controller, which consists of a shorter estimation, but longer than Echo, like this is looking for 1 month or so, and a long-term estimation. So it analyzes historical return paths, probabilistically determines future asset prices in the branching tree structure. It's interesting. The only method to follow Warren Buffett's advice, when there's nothing to do, do nothing. That's the only process I know of that can actually do that. I'll show you why a little bit down the road. Norway's sovereign wealth fund. We did this back in 2008. It was reported in this book published in 2009. And the objectives were, it's a country model, longer horizons, looking at 20 years, optimize country welfare, include assets, liabilities, multiple currencies, transaction costs and portfolio rebalancing, mean reversion, changes in volatility, fat tails, economic environments, contingent liabilities, cash flows, and multiple limits and constraints. You can see it in the actual paper, which is at the end here. But the interesting part is 14 years on, in 2022, the model expected value is within a fraction of a percent of the Norway's fund's actual value. Well, of course, it depends on which path you take over the tree, but I think it was really quite an amazing, and this was published in the original paper, so there's no fudging. The proposal, what the outcome would be after that many years. Reserve Bank of India, again, it contains multiple factors, including multiple currencies, liquidity, safety currencies. This is their central bank, reserve adequacy, etc. You can read this. Very stable model, 27 different factors, 21 risk constraints over a 3-period branching tree. Echo. Okay, so this is, for example, what a longer-term estimation on the Echo price would be. You can see actually this is the red is a continuing normal price. This is the actual price oscillating about that and almost practically within the range. I've gone back to examine a lot of these functions. It's interesting that you can go back and find examples where you get this actual price staying pretty much within the range, which gives an incredible estimate of the return and the volatility, because the volatility is computed around the normal price. It gives you a different way to look at how important the actual returns are on equities that fundamentally obey this condition over a long period of time. This is a mean reversion thing. The Echo Algomax risk controller model has 30 global assets, resulting in about 500,000 variables and 500,000 inequalities. A little less, a little more. Looks something like this. The actual estimation. This is a forward estimation. It's not a back test, which means that each and every month we estimate what the rebalancing in the portfolio is. We include the transaction costs in the returns, and then we've been estimating this over several years. This is the outcome compared to the other. Tailored models and inquiries, contact our portfolio. Robert, who is also going to make a few comments in the next slide, as a matter of fact. Norway Sovereign Wealth Fund. This is a little bit messy to see right here, so you won't find it in the original paper. But it's, again, estimating the fundamental price, variations around it, the crash. Actually, you can see here, and moving outside the range, bubble forming, estimation, going down, and this is mean reversion recovery. And this is what the tree looks like, by the way. You notice that it tends to be, okay, it's heavily weighted on the upside, and the Sovereign Wealth Fund is done pretty well. We're able to capture much of that in the original. Reserve Bank of India was the other one I mentioned. And again, this has a little bit more even tree. And the important thing to note about these, a lot of people think of building a tree structure with equal weighted branches. They are not. You're never going to build equal weighted branch tree on 30 assets over a couple of periods of time, which is what happens in the Algomax Echo. They're not equal probability. That's the main thing. But the branching tree is mean reverting. You can actually see some of this here as these branches tend now to point back down in the future after going out. This is a low probability branch. Okay? But these are the factors that are included. Okay, you have different funds, you have cash in different currencies, you have short rates in different currencies, long bonds, corporate bonds, etc., exchange rates, external debt by related. These are measures that central bank needs to take into consideration. External debt, GDP, liquidity, and so forth. Okay. The main thing is this is a smart tree. Difficult, it's tricky to build a smart tree. That's what we're trying to do here, because a lot of times we see that actually, even in this case here, there are periods where we don't need to rebalance every month, but this is the case where we took the case of rebalancing every month and including the transaction costs because it aligns more with industry. Rob, you want to make a couple of comments about this? This is some of the stuff that comes out of Echo, which there's a lot there, and I think we will have at some point another presentation, basically with a lot of the stuff that Rob comes out with to measure the results and even to make some predictions on how to tilt the rebalances coming out of Echo looking forward, which actually in this month has been incredibly valuable also in previous months. But I have to say, even at least up to the end of the day yesterday, when they had that downturn, it's still performing quite beautifully. Rob, why don't you take over?
Sure. So as Jerome mentioned, the implementation part is up to me, given my experience with trading and portfolio management. But I'm also deep in the weeds with data collection, as well as turning the crank on all of these numbers and seeing what is the best way to utilize Jerome's IP. When we first started talking about a product, I suggested that we do it on global assets. So we have stocks, bonds, currencies, and commodities globally, because they were highly liquid asset classes that we could implement using futures. And there's no security selection. So all these results that you see here, these are just currencies as an example. There's no security selection in any of the process. The currency example I show here utilizes the hedge score, which is one of, as Jerome said, many of the outputs from the Echo process. And this is just simply going long the currencies that have a high rank on hedge. This is a cross-sectional ranking. And as you can see, the better performing currencies are the longs here. The shorts are in magenta color. So the underlying, I call it a benchmark, it's just an equal weighting of the 7 global currencies that we have in our investable universe. So there's very nice outperformance within currencies. Another metric I wanted to show here is the correction probability, and this is again over these currencies. So if a particular currency has a high correction probability, it winds up in the high bucket, which is the blue line here. If it has a low probability of correction, then it winds up in the low bucket, which is the magenta line. So as you can see, over the past 5 years, there's quite a substantial outperformance within currencies, which really are not that volatile. So these alphas are quite good, given that currencies don't move around as much as other things like equities and bonds, and particularly commodities. There's a lot more work to do on this. The Echo score is actually the alpha source that is included in the optimization when we produce the portfolio. And much of this stuff is available on our website, riskcontroller.com.
Thanks, Rob. But let me add just one thing, because it may be a little confusing to viewers. If you look at the correction probability, you see, I get a high correction probability. Why is the blue line so low? And the answer is obvious. Maybe not obvious, I'm sorry, but the obvious one. If the correction probability is high, then it's more likely to crash. Well, it could be a rally, but what I was telling you before, the crashes are much more prevalent than the rally. Well, if it's going to crash, what happens? The return goes down. Mm-hmm. So you expect to see it, and that's exactly where you expect to see it, which is a good indicator that, hey, the crash probability is working. If it's low, it's likely to continue at the same rate. So it should be maybe slightly above what the actual price is, and that's exactly. So I just wanted to clarify that if some people were confused. Okay, so I'm going to finish up on the next line. For these Augermax inquiries, contact Robert. The end, okay, it's not really the end, it's actually the continuation. And you can find everything we talked about at these locations. Comments and questions can be sent here. And then inquiries on the portfolio to Robert. He's the custodian of that operation. And I just put 2 little things here. These models can be dynamic, tailored, risk, etc. You're not just getting a product, you're shaping your future.
Yeah, thank you.
And that's it. Okay.
Thank you very much. Thank you for presenting the model. I mean, it was very interesting. I have 2 questions actually. So firstly, I would like to touch the Kelly criteria. We started discussion. I didn't want to ask the question in the middle of the presentation. I wanted to ask it at the end, but as we all know, I mean, the Kelly criteria is trying to maximize the log of the wealth. So it's not looking at the risk itself. So the risk is not in the optimization. So I mean, what you are doing when you are betting based on the Kelly.
But it is.
Show me. Because my question was that when you are betting based on the Kelly, you are maximizing the wealth, but the path to the wealth can go through different directions. And I mean, it can be more bumpy than the customer would like. So what does it mean is that the model should include some way of the tailoring to the maximum risk. So that's the question. I mean, how to do that in the real life or in a model. So that's the question.
If you look at this slide, now this is what you're doing, maximizing the expected wealth. But this is the expected wealth. So with the expected wealth, if you're maximizing that, it must include some criterion about the risk. Mm-hmm. Because the expectation has to include the risk. In fact, so when you solve this, actually what you get is sort of like the very complex version of the simple version. What you saw was a mu minus r over sigma squared. Exactly what you're getting here. But it's a more complicated expression. It's excess real return. Yeah, okay, that's what we expect. Divided by the risk. Volume motion volatility plus expected jump volatility. The result actually does take the risk into consideration. And that's how it comes out of the whole mess here. And I granted, yeah, it's maybe a little confusing. But if you're maximizing expectation, then you have to include outliers. In other words, those that are at the extreme point, because they're part of the expectation. You know? In other words, you take this expression here And then you start running through, taking the differentials and taking everything into consideration. You end up with a term that looks like this approximately, because you can't solve it exactly.
Okay.
But that's the main components, plus some higher order factors.
Okay, thanks. And the second question, as I understand, the first part of the model deals with the individual assets, but I mean, how do you combine those assets together into portfolio when you have like 2 or 3 bubbles at the same time? So I mean, how do you weight those assets between them? I mean, each between another?
Well, yeah, I do have a way to do it, to look at subsets of assets and allocate between them. But the real allocation comes down here. Okay, so what you're getting here is short-term expectations. If you look at historically in the literature, you'll find results that imply that it's the expected returns that are the most important part in building the portfolio. In fact, these trees were done prior to Echo existence. These were done in 2008, 2010, 11, and you get a return here. You use Echo to refine that return.
Okay, thanks. Thank you very much, Jerome. Thank you very much, Robert. I like this a lot. I hope that the viewers will take some knowledge out of that, so it will be great for them. I would really like to thank you for joining me on this call. I hope that we'll have another one in the future, maybe not about another topic, or we will go deeper into some part of this model. I wish you luck in the trading in the future. So thank you. Thank you very much for joining me.
Okay, thank you. Thanks for the opportunity.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.